Have you heard that inflation is down, yet when you go to buy things, the prices are still very high and you're confused as to why is that if inflation is down? Well, this is a result of disinflation versus deflation. And in this video, we're going to deep dive into that topic and how it affects your wallet, your savings, and yes, even those late night snack trips. We also need to consider how wages are not keeping up with inflation, and a little bit later in the video, I'm gonna share with you a very sad graph. Now, before we get to that graph, let's take a look at this graph, courtesy of Trading Economics. And at first glance, you might look at this and say, oh, okay, well, in January, our inflation rate's only at 3.1%, and that's down compared to 6%. So that is good, right? Well, it doesn't mean that prices are down by 3%, and this is where the term disinflation comes into play. See, prices are still rising, just at a slower rate than before. This is why that $2 slice of pizza back in 2021 now costs $3, maybe even $4 today. So instead of saying things like inflation is down, we should say disinflation is occurring to be actually accurate. But believe it or not, disinflation is actually a positive indicator. And here's why. It means that we're easing off of a red-hot economy and hopefully avoiding a major recession. But we're going to see how this actually negatively impacts wage growth, in my opinion, a little bit later in the video. So if that's disinflation, what is deflation? Well, deflation is the opposite. That actually means that prices are going down. And it also means that inflation rate is below 0%. That means the cost of groceries are coming down. That means pizza and beer costs a little bit less than it did before. And you might be thinking to yourself, man, I need some deflation in my life right now. But it's actually a bad thing, and here's why. Because deflationary cycles can actually start a downward spiral. And how that works is demand for products go down because people think, oh, prices are coming down. I'll wait to buy things because I think prices are going to go down even lower. And that means companies are cutting production because demand is down, they lay people off, and then we end up in a recession or a very bad period of time. And deflation happens when we are in a recession or experiencing economic turmoil. If we look here on Trading Economics, you can see the last time we had deflation was back here. You can see it's down below 0%, and that's during the great financial crisis of 2008 to 2010. But that is the last time we truly had deflation to that great level. So that's the bigger issue. If prices are always going to be high as they are today from now ongoing, and disinflation is happening so that we can maintain that happy sweet spot of a 2% average year-over-year inflation rate, how are we going to be able to afford things? And that's the other issue that we need to explore in today's video. So with disinflation going on, the prices of things aren't coming down unless we hit a recession or economic turmoil, which none of us want. But that really means if wage growth is not keeping up with inflation, the poor get poorer and the middle class, they get squeezed. Going back to Trading Economics, this time we're looking at the wage growth indicator. The average growth is only increasing by about 5, maybe 7% on average, looking at this entire period of time that we have up on the screen. But inflation has been red hot, especially in 2021 through 2024, averaging about 6% and peaking up to almost 9% year over year. And if this wage growth stays at a steady 5%, even with disinflation going on, you're going to continue to still have a struggle of affording things as you did in previous years. This is why people often compare the 1980s to today, where back in the 1980s, somebody could afford a nice home, a nice car, and a full cart of groceries every week on a standard salary. Sometimes even one person, one parent in the household was working, and they could afford everything they need. And it seems like today, we can't keep up with that. And I think some of this is the cause of it, where you have this high level inflation, and even with disinflation, wages are just not keeping up. And that brings us to this sad graph that I mentioned earlier in the video. And it's right here on Trading Economics. What I'm going to do is I'm going to hit right here max time, and this is the wage growth through the max period, and I'm going to hop over here to our inflation and also hit max. Now, what I'm going to do is I'm going to add a trend line right here. Go to chart, I'm going to hit trend. Now look at the trend of this. You can see it's actually inching up. This is inflation, it's inching up. Even if we compared 1960 right here all the way up, and you're just looking at 1960 upward, it still has an upward trend line, which means even with the highs, even with the deflation, it's still going up. So it's not major, but it's a slight increase. But let's compare that to the max on the trend line of wage growth. Now you can see it only goes back to 1960, which is why I was only comparing 1960 in the inflation chart. Because if I trend this one, here's the sad part. Look at the trend line in wage growth from 1960 to today. It's actually going down. So here we have inflation going kind of steadily up from 1960 to 2024. And on this chart, wages are going down. This ultimately is why people are upset. This is why people are saying what they're saying on TikTok. I can understand when we look at it from this perspective. Now, I'm an optimist, and I'm going to say, what would I do in this case, despite the disinflation, despite the wage growth, and I'm stuck in this position, what do I do? Here's what I would do. The first thing is I would look at my income. And if you're looking back on all the different maybe wage increases you've had in the past, maybe you haven't gotten a raise in a couple years, and that's even more painful because now you're stuck with all this inflation going on, and you're stuck at the same salary you were at back in 2019, that could be very dangerous. So you got a hard decision to make. Either you ask for a raise, or if your company is not willing to give you that raise, you may have to find another job that pays what you need in order to afford your lifestyle. That's going to have to be the cold, hard truth of how to actually manage this. Now, the other thing that we can do, especially if you love your job and you're not interested in leaving right now, is you could look at side hustles. Now, interestingly enough, in the United States, the average person who does a successful side hustle can bring in up to $800 more per month. That could be the difference that helps you with these rising costs. But I do want to caution that you want to still live your life. Don't go all in on side hustles just to make a bunch of money. Meanwhile, you have no life, no time to spend with your family, no time to spend with your friends. Make sure you balance that out while making that extra income. But I think even more controllable is also looking at expenses. Even with inflation and the prices of things going so high, is there something that we can do to lessen some of these expenses? I'll share what I've done just recently is I cut cable, and now I only focus on streaming services. I'm saving a lot of money with that. We also changed our cell phone over to Mint Mobile. I'm saving 50% against my old bill simply for changing over to Mint Mobile. And so if you're looking at some different ways to cut your expenses, I actually will break down a significant amount of how I'm saving so much money to offset some of this disinflation. And in order to learn about that, you got to check out this video next, and we'll see you on the next video.